Hey everyone, welcome back to Yuri's Box. In this video, I'll be answering the comment section. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So again, if you're new to the channel, every now and then, what I like to do, mostly as a thank you to everyone that interacts with the channel, likes, comments, anything. I like to go to the comment section, and if I find comments that I find thoughtful, or if you have questions, I'll do my best and answer them, to the best of my ability. So again, this is my way of really saying thank you to everyone. And really, the first comment I like to address is this one here by Countcho. The revised numbers are not going to look good. The trend is revisions down in large numbers, so we're probably going to get 4.3 after the correction. Now, you usually see revisions to the non-farm payroll report. Now, as far as the unemployment rate is concerned, yes, this number right here was extremely close to, rounding up to 4.3, which, given last year's revisions, 4.3 would have been a local high, all right, for this cycle, for the unemployment rate. All right, the unrounded unemployment rate came in at 4.244%, up from 4.187% in April. All right, so I mean, we're barely there. Right? We don't really need that much in terms of initial jobless claims. All right, we're still fairly elevated. All right, I mean, granted, in the context of history, we're still at extreme lows. All right, there's no sugarcoating that. But regardless, my kind of line in the sand, I've said this many, many times, is anything below 215, you can expect the unemployment rate to come down. Anything above 220, you can expect the unemployment rate to move up. And that is basically what we've seen, right? That has been a good barometer, in my opinion, of where you could expect the unemployment rate to go. And again, to address the unemployment rate going up, I mean, it wouldn't take that much, to see 4.3 next month, right, in next month's report. So do keep that in mind. And also to address the revisions, which is a very good point. This is something that I've been pointing at, in the lead up to this month's non-farm payroll report. And what you really want to watch is, again, this part right here. All right, the third revision. Why do you want to look at the third revision? Because usually the first round, really the first print in non-farm payrolls, has very, very low respondents rate. All right, so not a lot of businesses actually fill in, the survey, and so it's usually less accurate. And as time goes by, more businesses respond, and you get a number that reflects reality better. All right, and what we've seen is so far fairly consistent with what we've seen last year. All right, I remember a lot of like Zero Hedge. Zero Hedge used to pound the table on this quite a lot, calling it Bidenomics or Biden whatever, Biden shenanigans, where you would see the first print be fairly positive. I remember last year we had non-farm payrolls come in at 300K or something like that, extremely strong. And by the time all the revisions were in, we were down at 100K. All right. And same thing applies for 2025, really. All right. Now, granted, Zero Hedge isn't reporting about all of these revisions as they used to, given the fact that Democrats aren't in office. So that is, you should keep that in mind as well. But regardless of who is and who is reporting about this, it is happening. If you look at January, we printed 143 revisions, 111. February came in at 151. We're down at 100. March, which was extremely strong, 228. We're down at 120. April came in at 177. Second revision revised lower to 147. Who knows what the final number for that will be. Now, May could also be one of those months which gets revised up to the upside, and I'm contemplating that for the simple reason that really for everything that we've read in, the beige book. Well, not really the beige book. I didn't have time to make a video about that, but regardless, the PMIs, the ISM, they all pointed towards the fact that May was at least somewhat more positive compared to previous months, because we had that bump up, all right, caused by tariff, relief, all right, trade war relief, all right, where we went from, again, total decoupling to something that is more manageable. Again, 30% tariffs is more manageable than decoupling. It still isn't good. It's bad. It's very bad, but it definitely is more manageable. So, given that theme that played out throughout May, this could also be one of those months where we get an upward revision. Now, having said that, we've also had months where initially we got revisions to the upside, but then the QCEW, which, if you're not familiar with their work, it comes along and it shellacks everything. It just takes out the saw and it saws everything in half. And again, what is the QCEW? It's basically the non-farm payroll report on steroids. Right? The sample batch is much larger, and usually they are more accurate. All right. And in fact, if you recall, last August, it was August of last year, at the end of August, we got a huge report at the end of August where, the QCEW announced that job growth was lower by 800,000 jobs, all right? In the year ending, I think it was March of 2024. All right, now that was revised a little bit higher. It was negative 600K by the time. Let me see if I have the article for that. No, I don't have that open. But regardless, by the time December came around, that was revised higher to negative 600K. And that basically chopped the legs off of, a lot of the job gains that we saw in the month of, really the whole year of 2024. And in fact, the numbers that you see right here should be reflective of exactly that. Let's get this out of the way. All right, December was revised up to 300K, and overall, yeah, I think this is updated. Now that I think about it, yeah, and again, by the time the revisions came in, a lot of months got revised lower, even lower than they were already revised by the time the third revision came in. So all of this to say, although May could also be one of those months where we get revisions to the upside, usually the QCW comes in, a couple of quarters later, and it just, takes it all away, kind of rug pulls everything. Now, again, I try to, give this sort of stuff the right amount of, of importance, if you will, but not too much, because again, sadly, the market will react on the number it has. All right. And the number it has is the latest number. And the latest number is, of course, 139. All right. And 139 was fairly in line. It was okay, meaning it wasn't bad. All right. Now, of course, what you're going to say, but what if this gets revised lower? This will matter when it matters. All right. And this brings me to the next question I wanted to get to. Which one was it? Oh, let's go with this one here. By Matt Engels. You mentioned CPI might not affect TLT that much, but what if inflation comes out quite lower than expected? It would kill all the stagflationary fears. I feel like that could cause people to sell gold and buy bonds. Might just be me daydreaming though. Well, again, all of this will matter whenever the market decides it matters. All right. Same thing in 2008. All right. I spoke about 2008 many, many, many times. And I still do believe there are quite a lot of analogies with 2008. Now, I'm not calling for, canned tuna and canned corn and hiding in a bunker and we're going to have a great recession. I'm not calling for that. I'm just saying that when you compare this cycle to 2008, well, you start seeing that, first of all, just brutally looking at, the chart. I've pointed out this out many, many times. The 30-year chart looks eerily similar, all right? You have your first move up, move down, noisy move up, sideways, and kind of W formation right here. And if you go back to 2008, well, this is basically it. All right, you have the first move up, retrace, a noisy move up, sideways action, and then your W formation right here. Now again, this part is probably a little bit more different compared to today's price action, but regardless, even in 2008, even here in the midst of, Bear Stearns and everything, yes, rates had come down, okay, but we still found a way of going up by about 63 basis points. All right, we basically went back up to where we were, in April 07, right? And why did we do that? Well, one of the reasons is because they actually had inflation. All right. And a lot of people were talking about how the Fed was behind the curve because at this point in June of 08, all right, the Fed had actually already cut rates by quite a significant amount. If you recall, right here, by the time, January rolls around and February, we're at 3% compared to 5.2% before which was the top for interest rates. And so, and again, if you look, in June, by the time June rolls around, pardon me, at 2%, forget 3%, we were at 2%. Why? Because there was inflation. There was a huge problem with inflation, all right? If you just go and look at a chart, inflation peaked in July 08 at 5.6%. All right, all the while, one of the worst recessions in history was brewing. And again, nobody was really talking about the fact that the US was in recession in a way. All right, yeah, there were problems, there were things brewing, but nobody had declared a recession in a way. At the end of the recession, everything got backdated to December 07. And so now it's, consensus that the recession started at the end of 07. And the US was in recession throughout 2008. But in 2008, again, nobody really, nobody knew they were in recession. And therefore, the market didn't really care about that. All right. We all think about this kind of move on the long end of the curve, this move right here. And this is, we always point to this move and we say, why isn't it doing that now? Why isn't it doing that now? Well, this move right here that everybody's, thirsting about occurred at practically the end of the recession, all right? By the time this move occurred, it was a couple of months before the recession ended, all right? And all of this is a long-winded answer to say that when will the revisions count? When will it all matter? It'll matter when it's blatantly obvious, all right? Just like in 2008, yes, rates moved lower, but even in the worst times of the recession, which again, a lot of people didn't know they were in a recession back then, but even while the worst recession was brewing, we still found a reason to go up in rates, all right? Even during the Lehman Brothers collapse in the middle of September, we went up by about 50 basis points. I pointed this out many, many times. In the worst times of recession, we still find ways to deviate. All right. So don't be surprised if, all of this seemingly doesn't count. That, to me, it does count. To me, it just tells me that potentially rates are mispriced. All right. and that the Fed and the market is behind a curve, and full stop. All right, so that's how I'm kind of going about it. Now, to answer the question about CPI, again, the reason why I still I'm on this theme of all this might not count, simply because as of now, the market seems hell-bent on this stagflationary outcome. All right. And again, I've pointed this out many, many times. You have potentially rates pricing in the inflationary side of things, and potentially the dollar pricing in potentially lower US growth. And what we've seen so far is, inflation reports, which have been incredibly positive for TLT, but it hasn't mattered. It hasn't mattered one bit because, again, the market is hell-bent on pricing in this stagflationary environment. Now, again, I've talked about this many, many times, and I've said many, many times that that isn't my base case. I think that potentially we might be living through it, potentially right now, potentially throughout the following months, whenever it is we have to restock at increased at tariffed prices. Potentially might see a bump in inflation. But again, I go back to my base case, which is, given the state of the labor market, I don't think there is a wage spiral problem, given the fact, where the quits rate is and everything I've spoken about before. And so while we might see some hints of stagflation, that's just, the bridge that'll take us to some kind of a landing, a soft landing, a hard landing. I don't know what it'll be. I just know that it'll be some kind of a resolution to the economy. That's how I'm going about, TLT, and that's why I'm bullish on it, right? But again, it'll take time. That's it. It's gonna be you're gonna need patience. Patience is the name of the game with TLT. If you're waiting for TLT to do, these gangbuster moves as if it's, some, altcoin or whatever, I mean, you're gonna just end up watching paint dry. I'm gonna be completely honest. This isn't, the show that you're looking for if you're looking for gangbuster moves. So again, CPI, if it comes in cooler, be prepared that it might not matter. Now, until it does, eventually, as I've been, talking about in this segment right here, revisions might not matter right now. CPI might not matter right now. But later on, eventually, my opinion is it will. But again, that's why you need patience. All right. So just to answer the final part of the question, that will cause people to sell gold and buy bonds. Now, again, this is something that I've spoken about quite a while ago. I haven't gone over it, but usually what you see is exactly what what Matt pointed towards, and I highlighted this in my previous videos, how even the move in gold isn't too dissimilar to what we saw in 2008. All right, we see our first move up, sideways action, and then we just blow off. All right, if you look at today's price action, what you have is move up, sideways action, and we blow off. All right, and now why does gold go up? Gold goes up because, well, what is it correlated to? Nothing. That's the beauty of gold. It's not correlated to anything. The only thing it is correlated to is uncertainty. If there's uncertainty in the market, people don't know what the outcome might be, gold goes up. But eventually, you get to a point where you know what is going to happen. And if you know what's going to happen is again, some kind of a landing, a hard landing, a soft landing, that's usually when gold starts to suffer. And it passes the baton over to bonds. All right. Now, again, I come back to, what I just finished explaining. This will happen when everything starts to matter. Currently, the market's on a mind of its own, particularly the bond market. All right. The bond market is hell-bent on pricing in stagflation. It's not. merely considering recession. It's just looking at good growth, stimulus galore, tariffs are going to cause inflation. That's what the bond market is telling me, right? Whenever we get to this point right here in gold, it'll be because it has become blatantly obvious that data is slowing down, economy is slowing down, and we get to a point where we have to price in some kind of a landing. At that point, I would expect gold to suffer a little bit. Again, suffer. What do I mean, suffer? Well, nothing too great. I mean, would I be surprised if we revisit the 2400 region now in that kind of a scenario? I still do believe that, I'm bullish gold over the long term. Again, would I get overly bullish at, 3300? Not really. All right. Just like stocks, this is where you wanted to get bullish right here, just to move on stocks. This is where you wanted to get bullish. This is where you want to get bullish. Right here, yeah, I'm open to stocks going up, but, the time to get bullish was right here, not here. If you're getting bullish now, it's because you weren't bullish back here, and now you have to get bullish, all right? That's the way I'm looking at things. So just to reiterate, we will get to this point, and that's been I've been arguing in favor of this for, I mainly spoke about this during the tariff drama, and again, eventually I do think that we will get there. When will we get there? When everything starts to matter. All right. And this leads me to another comment. Actually, I get two from FOSS98. And I'll go with this one first. How much longer do you think we can see TLT suppressed? That needs to be refinanced at lower rates. Tariffs will significantly slow down growth. What are your probabilities for a breakout happening end of this year or end of next year? So let's talk about, TLT for a second. And a little more broadly, the bond market. All right. How much longer can this go on? All right. And the main argument I'm going to propose in this part of the video is quite simple. There's this idea that the bond market is kind of where the smart money is. The bond market is all great and all seeing, and you should pay attention to what the bond market is telling you because, the bond market doesn't have earnings, it has fundamentals of the economy. And so whatever the bond market is saying via rates, you should pay attention because more often than not, it's right. Opposed to the stock market, which is just, chimps in a zoo. The stock market doesn't know anything. All right? If you want to pay attention to the bond market, not the stock market. And I've, gone over this quite in my previous videos as well, but I want to reiterate this because I have strong opinion about this, all right? So here goes. If you look at this cycle, right, everything that occurred from, the end of 2021 onwards, every step of the way, arguably except this first move right here, the bond market has been wrong. Dead wrong. Whatever the bond market has said from October of 2022, dead wrong. And you were better off ignoring what the bond market had to say about the economy. Why? Well, we get to October of 2022, and we start immediately pricing in rate cuts. All the while, central banks all over the world were still hiking rates. Right? The Fed still cranked out about 100 basis points of rate hikes, if I'm not mistaken, if not more. But even while they were cranking out rate hikes, just look at the 30-year chart right here. We were pricing in rates going lower. Why? Because we were going to have a recession. And we we're going to have rate cuts. Okay. Did we have a recession? No. So then what happens? Well, the bond market has to play catch up. And at this point right here is where we start getting into the higher for longer rhetoric, narrative, if you will. But at this point, we say collectively, hey, hold on a second. If inflation is well behaved, we can maybe move lower in rates. All right, we move lower in rates. Inflation was not well behaved. Spoiler alert. Inflation stays sticky at around 3%. All right, this time frame right here. And so we have to move back up. And this is where we have higher for longer again. But then inflation is actually well behaved, and we get that growth scare throughout the summer, and so we move back down. And this is when we start to price in, potentially the economy slowing down a little bit more, and then, potentially, is it going to be a soft landing, a hard landing? Is the labor market going to collapse? Is everything? No, we get absolutely not. Rates have to move back up. All right. Throughout this cycle, recessionistas, deflationistas, inflationistas, everybody has tried to hang their hat on top of the bond market, in search for answers. Recessionistas right here, and I was one of them, right? I was fairly inexperienced. That doesn't mean that doesn't mean I'm experienced right now, but I certainly do know more than I did back in 2022. Recessionistas, again, were hanging their hat on the bond market because the bond market was saying we were going to have a recession, pricing in a lot of rate cuts. All right. Then, the no landing and inflationistas said, this is it right here. Rates are going to move up. The bond market is going to collapse because of inflation. Then, you have the deflationistas coming back in and you say, inflation is going to come down. That is what the bond market is telling us. Then, it goes back to the inflationistas. Then it goes back to the recessionistas. Now it's back in the hands of the inflationistas. Throughout this cycle, for all the talk that the bond market is smart and, all-knowing and all-seeing, if you just followed the stock market, you would have been right, all right? For all the talk that the stock market is a bunch of chimps in a zoo, there are probably, a smart bunch of chimps. If we're talking about chimps in a zoo, when we're talking about, the bond market, the stock market, the bond market is still, a bunch of chimps in a zoo. The only thing is that perhaps they have, a tuxedo, they're smoking a cigar, and perhaps they have, a smug, British accent. No offense, obviously, but, just to sound smart. But at the end of the day, they're still chimps in a zoo. So keep that in mind. Just because the bond market is telling you something doesn't mean it's necessarily true. As I've been pointing out in this part of the video, everything the bond market has said in this cycle has been wrong, and whoever tried to claim victory in the bond market, with whatever narrative has tried to claim victory in the bond market has been proved to be wrong, because the moment you price something in, it just goes the other way. All right, it just flips 180, and we're back to inflation galore. Right, so do keep that in mind. What are my probabilities for a breakout? Now, to answer the second part of the question, I started making videos in February, and I wasn't really expecting much from TLT until the summer. All right, yes, potentially, I would not have been surprised, and I wasn't surprised with TLT moving up during the this time frame right here, because we still had data coming in which was negative, right? Like we have now. We have the PMIs coming in worse than expected. Initial jobless claims, that was another part of my thesis. Initial jobless claims would bottom in January, and then we would see a slow grind higher in the initial jobless claims. That has all occurred. Now, what I wasn't expecting is this this tariff drama to go as hardcore as it actually did, and of course that caused all this stagflationary drama to take effect. Now, having said all that, I always talked about the summer as the first checkpoint, if you will. And the reason for that is that, again, if you look at last year, initial jobless claims tend to peak during the summer. We also saw the growth scale last summer occur as well. Now, we all know that the starting point, given, the revisions, given everything we've spoken about before in this video, is lower compared to last year. And so, as far as I'm concerned, I'm just curious. I'm just watching to see how things are holding up as of, let's say, the beginning of September. How do we get through the summer? That's checkpoint number one, as far as I'm concerned. I wouldn't be surprised, again, if we get some kind of a repeat of last year, all right? Everything seems kind of okay in June. Everything kind of seems kind of okay in July. Oh, wait, it doesn't. And then we have to kind of rethink, our interpretation of the US economy. Okay, so I'm not fairly good with, predictions, when things will happen. I don't know. Again, I come back to what I was saying before. Things will happen when they will happen, all right? What you want to look at is basically the data, because that's your best ally at this point. You want to continue to see deterioration. And if you don't get deterioration, potentially we'll have to reconsider TLT, all right? I think that if you want to, again, just to reiterate the point, if you want to look for, some kind of clue of whether we can get some positive price action in TLT, I think this summer is definitely the place to look at. All right. Whatever the situation is as of September, then we'll reassess from then on. Because again, that initial jobless claims have continued to grind higher. Let's see how high they grind, and let's see how the unemployment rate goes, and let's see how non-farm payrolls hold up. Knowing full well that the starting point, again, as we spoke about in the first part of the video, isn't that strong. All right, not by a long shot. And if you look at last year, payrolls for May were at 272. If I'm not, this is 2024, yeah. So, and this is not counting the revisions by the QCEW, all right, that I spoke about before. These numbers were chopped by quite a bit, all right. This year we're at 139. I'll leave these numbers right here for a second, so you can pause the video if you want, and just look at the numbers for yourself. All right, the starting point is much lower. All right, doesn't mean we're in a depression. It just means that the economy is slowing down. And if you're bullish TLT, that's what you want to see. And it just means, as I've said in my previous videos as well, that you're at risk of potential shocks, whatever they may be. There might not even be something significant, but let's just say that perhaps the yen carry trade or something like that, even nothing too huge. Again, I'm not saying that the yen carry trade isn't huge, but let's just say something benign happens. The economy isn't strong to potentially absorb it. All right. And so any negative news might be amplified by the fact that the economy is in slowdown mode. All right. So again, that is kind of a long-winded answer to this question right here. Probabilities for a breakout. I think that this summer will be quite telling in my opinion, given everything we know. Okay. Just to go over TLT for a second before I answer the final question, which is another question by Foss98. You're getting two today. I wouldn't be surprised if, for whatever reason, we have perhaps a fake out. We sweep the previous low and then we go back up. I wouldn't be surprised if this is the way we go about this breakout right here. Does it have to happen? No. Given also the fact that potentially we are at the end of where is that? The 5 waves potentially. All right. right here, 2, 3, 4, and 5. Potentially this is the show right here, and potentially now we're moving higher. I don't know. My best advice is to keep an open mind about everything. Do keep something on the sidelines in case we do get this final flush below the previous low, which again, given the context of history, would be, realistic, okay? But it also keep in mind that TLT does the exact opposite as well, all right? Don't really try to time this. Even Warren Buffett sold everything last year, and potentially he's an old fart and doesn't know any better, But again, he doesn't try to time these things, so I'm not gonna try to time. I'm just gonna chill. I'm gonna enjoy the coupons and enjoy the treasury market. I don't really have to stress on stocks, which again, for all the talk that we went up, we're up. What? How much is this? 15%, 25%. The stock market has done nothing in terms of performance ever since November of 2024. All right, it's just been a roller coaster of emotions. Even before, I mean, since October of 2024, all right, the stock market has done nothing. All right, we've been range bound for about half a year. Is that if you're a trader, absolutely, that's your wet dream, absolutely. But I want to sleep well at night, so again, I'm just enjoying the treasury market as long as I can enjoy it. All right, so hopefully that is really a long-winded answer to your question. And again, the summary is, look to the summer. Let's see how things how we get to the summer. What shape do we get to the summer? Do we get some further shocks? Perhaps do we get some more tariff drama? Perhaps negotiations don't go as as well as people are thinking. And again, I remember specifically talking about this, and I promise I'll move on during April. The last time we had this tariff war in 2018, it took about a year and even more, even longer, to just get a truce. Forget a trade deal. It took almost a year to get a truce between China and the US. All right, so do consider that as well. So again, summary, look at the summer. Look at the data as it evolves during the summer and reassess from then on. And again, keep an open mind on TLT for this kind of move right here. Okay, now the final question is again by Foss98, and this is a question I really want. I've been wanting to answer. I've been wanting to go over this question by from quite a bit. And this is right here. That's rather more consideration. It's more of a comment, really, as Norm Macdonald would used to say. God, I miss him. I agree that the Fed are usually late to the party, but don't forget that signaling that they are going to hike or cut rates does itself impact the economy to expand or contract. It's as much a market psychology tool as it is a monetary one. And the short answer to this consideration, and again, I'm probably a bit on the more extreme side, where I don't think that rate cuts and rate hikes have such a huge effect on the economy. I believe they have an effect, but it takes time for them to have an effect, meaning you're positioning monetary policy today for how you want the economy to look like in 18 months. All right, it's not a light switch. And really what I talk about whenever people ask me about this is that it's important not to fall for what I call the Wizard of Oz syndrome. All right, if you've watched the Wizard of Oz, you'll know that when they first meet the Wizard of Oz, it's this big floating head. It's got fire, green flames. He's all powerful. He's got this loud voice, and at the end of the movie, it's just some dude firing up cylinders and moving levers. That's all he is. All right, and why do I say this? Because for all the talk that we have no faith in politicians, because again that's what central banks are as well. There are politicians, if you will. Um, we kind of hang by, each of their words. What is the Fed doing? What is the central bank doing? Oh my God, the central bank did this. The central bank did that. And again, probably I'm a little bit too skeptical, and probably the truth is in the middle. But I don't think that their actions have that much of an effect on the overall economy in the short term. All right, and I'll give you an example of what I'm referring to. Let's look at inflation for a second. We were on the downtrend in 2024. Then in 2024, we bottom out at 2.4%. And we go back up to 3% as of January of 2025. Now, when people talk about this time frame right here, a lot of what people say is that, see, that damn Fed, they lowered rates by 100 basis points and they spurred inflation. If only had they stayed put, inflation wouldn't have happened. Now, again, to come back to the original thought, does it have some kind of a psychological effect? Absolutely. I'm not discounting that. But what is more likely? Was this, uh, the scheming of the Fed, and this is, the Fed caused inflation to go up, or was it just a result of the economy, reacting to whatever events were occurring during that time frame? And we had a lot of events occurring during that time frame. All right, what did we have from September to January? Well, we had port strike fears. We had natural disasters, which again, if you have a lot of things damaged, you have to rebuy things. That puts pressure up on prices. You had election euphoria. You had, a lot of pricing in, small caps went up by a lot. You had a lot of enthusiasm because, Trump is extremely pro-business, so we're going to have, lower taxes, all the good stuff. That has an effect. And you also have some kind of, the beginning of tariff front running, in my opinion. All right. Why? Well, I mean, the dude ran on tariffs. All right. So don't be surprised if, he actually ends up doing tariffs. And so businesses potentially started to, warm up to the idea that, we have to pull a lot of demand forward. And again, I'm not saying that what the Fed doesn't affect the economy. It absolutely does. But what I'm saying is that it takes a long more time than people appreciate. Now, I can already hear your rebuttal. And what that would be is, but what if they drop rates to zero and they start doing immense QE? Well, yeah, absolutely. Then, if, the more severe their actions are, well, the earlier you're going to feel the effects of that. But as far as a 25 basis point reduction goes, I find it, I really find it hard to believe. That's my that's the way I go about this sort of stuff. All right, simply because, again, it kind of goes against my base assumption which is that whatever the Fed does isn't, proactive. It's reactive. Rate cuts aren't stimulus. They are a reaction to weakness. All right. And rate hikes, or the fact that they're not going to cut rates, is a reaction to, the other side of the equation not going in their favor, meaning inflation. And I've spoken about this in, probably my earlier videos. The best way to visualize this is the summary of economic projections in 2024. If you recall, as of March, we were still in that mode where, if inflation is well behaved, as Powell reported in October and November, we can absolutely cut rates. We'll start considering, moving, the federal funds rate lower. Okay. Fast forward to June, we don't have inflation cooperating. and everybody moves back up. All right, compared to March, this is June. Why? Well, because inflation was not cooperating. It was still sticky at 3%. And so what does the Fed do? It reacts to that. It reacts to the latest thing that smacked it in the face. If you fast forward to September, you get the exact opposite. It's rate cuts galore. Why? Because we had that growth scare. The growth scare was the last thing to smack them in the face. And so this is what they did. They react to the last thing that smacked them in the face. They react. In my earlier videos, probably the way I spoke about the Fed is that the way you should think about the Fed is like a business, all right? Imagine a business that it's newly born, and because it's small, it has the ability to look to the future, and whatever problems it may have in the future, it just looks, for answers in the future. It tries to anticipate things. It tries to be forward-looking. But if you will, as corporations grow, as businesses grow, they become more and more, if you will, preoccupied with just keeping things going. All right, it becomes a grind. All right, if you've ever worked in a big business, it's difficult to keep a big business looking forward. Businesses, the larger they grow, the more preoccupied they are with protecting what has been rather than expanding and looking to what will be. And that is the way I think about the Fed. The Fed is just this old, clunky, huge, old business, which is just more preoccupied with looking to the past, making sure everything is here. I'll rephrase that. Making sure that everything that was yesterday is here today. All right. And the only thing it does is reacts in relation to the future. Meaning, if something comes up, they'll react to it. But they won't look to the future for, what should we do? No. They look to the past and say, this has happened. And if this continues to happen, this is what we'll do. But that never happens because, again, past performances are never a guarantee. And so, again, they just wait for something. They continue to look back. They look back. And eventually something comes along, it smacks them in the face, and they react to it. All right. I think that it is more of a, let's say a coincidence that, we had this rise in inflation. All right. Because again, why did inflation roll over? All right. If, 100 basis points of rate cuts, are so inflationary, well, then shouldn't it really have just leveled off right here or just continue to go up? Again, I'm not a fan of that, of the Fed being all powerful and all knowing, that they're capable of influencing the markets as much as we think. Really, what I think about the Fed is that all they do is react. Don't look at them for any indication of what is going to happen in the future. And again, the only indication you need from them is that you have to know that they're going to react to something. All right. Whatever they do isn't because they think something else will happen in the future. Anything and everything they do is simply a reaction. Remember, the Fed is not proactive, it is reactive. And that is true throughout history. If you look in 2008, yes, absolutely, they cut rates in 2008. But even right here, all right, there was the temptation of hiking rates. All right. Just look at this article right here. All right, pushing for a Fed rate hike now. Yesterday, Federal Reserve Bank of New York President Timothy Geithner said following a speech in New York that tighter monetary policy from central banks around the globe may be needed. All right. And again, I'll slowly scroll right here so you can go through it yourself. Why were they saying this in June of 2008? Because they were reacting to inflation going up. All right. And you can rest assured that as inflation went down and, Lehman Brothers occurred, they reacted to that exactly. All right. So we got the zero bound, we got QE, and all the good stuff. All right. But again, that was not a proactive measure, that was a reaction to weakness. Just like this, the 100 basis points of rate cuts that we got were a reaction to weakness. And again, I still believe that this thesis is still intact, because again, what we've been living through ever since February is consistent to what we saw in the second and third quarter of 2024, meaning weakness in the economy. And what occurred from September to January wasn't, the scheming of filthy central bankers. It was just events, economic factors that caused, an uptick in the economy and inflation to move up. All right, I think there is a much more realistic explanation to this right here, rather than it's all the it's been manufactured by the Fed. Rather, I don't think that the Fed has that kind of power. And again, just to give my closing thoughts. And I'll recall something that I said in the beginning of this segment. Central bankers are a politician's politician. And what did I mean by that? Collectively, we as citizens, whenever a politician screws up, he's caught, having an affair or corruption or whatever, what do? We say, you remember when the economy went bad? It's all that jackass's fault, right? It's his fault. He ruined everything. If only we had a better politician, everything would have been better, and yada, yada, yada. Who do politicians have to point at? Central bankers. Whenever something goes wrong in the economy, what's the first thing politicians say? Well, maybe not the first thing, but what is, it's pretty high up on the list, honestly. They point to central bankers. All right. What did Biden do when, back in 2022, inflation was at 8-9%? Calls Powell over and he says, this guy's got to do his job. He's gonna get inflation down. It's his fault, because he didn't say it, but that was kind of implied. He's gonna raise rates. He's gonna kill off inflation. What is Trump doing now? The economy's it's great. It's a great economy. It's Powell's fault. When we had the central bank, the ECB, the European Central Bank, raise rates in 2022, Italian politicians, I can vouch for that because I'm Italian, were screaming at the prospect of interest rates going up. Central bankers are a politician's politician, meaning they're politicians, excuse. All right. They have them to point at whenever something isn't going their way. We'd have, everything would be great if if central banks lowered rates or hiked rates, whatever it is. It's just central bankers are there just to take the blame, as far as I'm concerned, for politicians. They're a crutch, if you will, and the necessary one. May I add, because again, as much as I despise and I dislike, central bankers in general, I'm definitely not in the end the Fed or end central banks camp, but that is a topic for another video. So again, just to summarize, it is definitely a psychological tool because again, you know, at a macro level, of course, you're saying that you're making money cheaper, and you're saying that you're getting less reward for parking your money, and again, you're not going to have as much of a safe return, and so you're incentivizing people to go out and take risk. Absolutely. But if you look back at history, did rate cuts ever stop a recession from occurring? Not really. They didn't stop it in 2008. They didn't stop it in 2000. They didn't stop it in 1990. And even during the 1970s, when we had, the whole shenanigans going on with the Fed, going up and down and up and down, rate cuts didn't stop a recession. Why? Because rate cuts are a reaction. By the time they're doing rate cuts, what had to happen happened. And we're already looking through whatever happened. All right. So I'll leave it at that. Again, just to reiterate, probably the truth is in the middle. When I give you my opinions, remember this. I'm just a schmuck with a YouTube video, as I always say. Okay. And I'm not here to convince you. I'm not here to say that everybody else is wrong and I'm right. I'm just here to give you my thoughts. And again, just really to say thank you, because again, this channel wouldn't be what it is, and again, it's nothing great. I mean, we're still very, very small, but again, it's my way of saying thank you for the fact that albeit small, we're 200 and nearly 220 subscribers. I could never have imagined being at this point so fast. So again, I'm just glad to to answer your thoughts and questions. So again, I'll leave it at that. Hopefully, this was insightful. Hopefully it was just insightful, right? I'll leave it at that. If you like this kind of content, consider leaving a like and subscribing, and I'll see you next time. Bye.